I am Daniel Reed, and I have spent my career as a financial analyst in one of the largest institutions. Many people are providing their opinions, but if you hear the perspective I am about to share about Nvidia earning and the market trajectory anywhere else, you can unsubscribe me or stop watching my videos. Nvidia just reported its most profitable quarter in history, $81.6 billion in revenue, up 85% year over year. Data center revenue hits $75.2 billion, a record. Q2 guidance of $91 billion, well above the $87 billion Wall Street expected. Earnings per share of $1.87, beating by 11 cents. An $80 billion buyback authorization. A dividend increase from 1 cent to 25 cents per share. By every objective measure, this was a blowout. The stock closed up 1.3% on the day, and then it faded after hours. This is now the fourth time in the last 5 earnings reports that Nvidia has beaten expectations and the stock has gone nowhere, or lower. The pattern is no longer a coincidence, it is a structural signal. Tonight, I am not going to tell you what the headlines already told you. I am going to show you what was hidden inside the numbers. The customer concentration that no one is modeling correctly. The custom silicon eating into the edges. The gross margin math that gets harder with every passing quarter. And the one question that Jensen did not answer on the call. The question that will determine whether Nvidia is worth $6 trillion or $3 trillion in 18 months. This is not a bear case. This is a reality audit. Let's get into the intelligence. The first hidden truth is hiding in plain sight. Nvidia has been a sell the news stock for over a year, not because the business is weak, but because the expectations machine has become more powerful than the earnings machine. Let's walk through the pattern. November 2025. Nvidia reports Q3, revenue up 62% year over year. Stock pops briefly, then fades. February 2026. Nvidia reports Q4, revenue up 73% year over year. $68 billion. Guides Q1 to $78 billion. Well above consensus. Stock drops 5.5% the next day. May 2026. Tonight. Nvidia reports $81.6 billion. Guides to $91 billion. Stock closes up 1.3%, then retreats in after-hours trading. In each case, the fundamental story got stronger. In each case, the stock went lower. This is not a demand problem, it is a valuation problem. Nvidia trades at 41 times trailing earnings. At $5.4 trillion market cap, it is larger than the entire stock market of every country except the United States. To justify that valuation, Nvidia does not need to beat earnings. It needs to shatter every conceivable ceiling. The options market is now pricing smaller post-earnings moves each quarter. The implied swing fell from 9% in February to 6.5% this quarter. That is the market telling you, we have normalized the impossible. A company growing revenue at 85% year over year is now expected to do exactly that. There is no surprise premium left. The second hidden truth is inside the guidance. Nvidia guided Q2 to $91 billion. That implies sequential growth of just 11.5%, down from the 20% sequential growth they delivered in Q4 of last year. The growth rate is decelerating in absolute terms, even as the dollar figures hit new highs. And deceleration in a stock at 41 times earnings is dangerous. Here is the number that Nvidia disclosed quietly that most coverage will skip and that matters more than the revenue beat. In fiscal 2026, 2 direct customers accounted for 36% of Nvidia's total revenue. That is up from 3 customers accounting for 34% in the prior year. The customer base is concentrating, not diversifying. Who are those 2 customers? Nvidia does not name them explicitly, but the math points to Microsoft and Meta, the 2 hyperscalers with the most aggressive AI infrastructure buildouts. Now here is what makes this a risk that is not priced in. Every single one of Nvidia's largest customers is building their own AI chip. Amazon's Trainium is now at a $20 billion annual revenue run rate. Amazon signed OpenAI to a multi-gigawatt Trainium deal. Amazon signed Anthropic to a 5-gigawatt Trainium deal. That is real revenue that Nvidia will never see. Google unveiled its TPU-8i and TPU-8t at I/O last week. Google also signed its own multi-gigawatt deal with Anthropic on TPUs, not Nvidia chips. Meta is investing in its MTIA inference chip. Microsoft has Maya 200. And then there is Cerebras, which just went public, has a wafer-scale architecture, and signed OpenAI as a customer. AMD signed Meta to a 6-gigawatt MI450 deal, and OpenAI is now roughly 10% of AMD's equity. None of these alternatives match Nvidia's full-stack ecosystem. CUDA remains a moat. But the narrative that Nvidia has no competition is no longer true. The competition is not AMD or Intel in the traditional sense. The competition is Nvidia's own customers building their own silicon, and then licensing it to the same AI labs that are currently Nvidia's fastest-growing end users. Here's the math that matters. Nvidia's data center market share has fallen from an estimated 87% in 2024 to somewhere between 75% and 80% today. That is not a collapse, but it is a trend. And in a stock priced for perfection, a trend away from perfection is all it takes. The third hidden number is gross margin, and this one requires reading between the lines of Nvidia's own guidance. Q4 fiscal 2026 gross margin, 75.0% gap. That was the recovery quarter after the H2O China charge. Q1 fiscal 2027 guided gross margin, 74.9% gap. Essentially flat. Q1 actual gross margin came in at. The market is still digesting the exact number, but management reaffirmed the path to mid-70s. Here's the problem. Gross margins in the mid-70s are excellent for any hardware company, but they are below the 78.4% peak that Nvidia printed in Q1 of fiscal 2025. And they are being achieved in an environment where Nvidia has effectively no pricing competition at the high end. If margins are flat to slightly down when you have a monopoly, what happens to margins when competition actually arrives? The answer is not binary, but the direction of travel matters. Nvidia's margin expansion story peaked in 2024. The next phase is margin defense. And defense is harder to price at 41 times earnings than expansion. There is also a hidden factor that changed this quarter. Nvidia started including stock-based compensation expense in its non-GAAP results. That is an accounting change that makes historical comparisons difficult. SBC was approximately $1.9 billion in Q1 alone. By including it in non-GAAP, Nvidia has effectively normalized a cost that previously was excluded from the adjusted numbers investors focus on. The optics are worse, even if the economics are the same. The question investors should be asking is not whether Nvidia can maintain 75% gross margins. It is whether Nvidia can maintain those margins while its largest customers route an increasing share of their AI workloads to their own chips. On the earnings call, Jensen was asked about China. He gave an answer that can be summarized as, "We are complying with export controls, and we have built a business that does not depend on China." That is true, and it is also incomplete. Nvidia took a $4.5 billion charge in Q1 fiscal 2026 because of H2O export restrictions. The H200 is now allowed under a case-by-case review with a 25% tariff and volume caps. But Nvidia's guidance assumes zero data center compute revenue from China. The hidden story is what this means for Nvidia's competitive position globally. China is not just a revenue line, it is the largest separate AI market outside the United States. By being locked out, Nvidia has created a vacuum that domestic Chinese champions like Huawei's Ascend chips are filling. Those chips are not competitive with Nvidia's best today, but they are improving with every quarter of protection from foreign competition. More importantly, China's exclusion forced Nvidia to absorb an $8 billion H2O revenue hole in Q2 fiscal 2026 alone. The company filled that hole with Blackwell sales to hyperscalers. But that required hyperscalers to buy more, which they did. The question is, what happens when hyperscalers cannot or will not buy more to fill the next gap? The bull case says sovereign AI demand outside the US and China, Europe, India, Japan, the Middle East, will absorb whatever China would have bought. Sovereign AI revenue more than tripled year over year to over $30 billion. That is real. But sovereign AI buyers are smaller, slower, and more price-sensitive than hyperscalers. The margin profile of a $30 billion sovereign book is different from the margin profile of a $30 billion hyperscaler book. And that difference compounds over time. So let's put this together. Nvidia reported a historic quarter. $81.6 billion in revenue, $75.2 billion in data center, Q2 guidance of $91 billion, an $80 billion buyback, a 25x dividend increase. On paper, there is no argument against the bull case, but the market is now telling you something that the income statement is not. The sell the news pattern is structural, not coincidental. The customer concentration is increasing, not diversifying. The gross margins have peaked. The competition is not theoretical. It is sitting inside Nvidia's own customer list. And the China question has no easy answer. This does not mean Nvidia is a short. It means the asymmetric upside that existed in 2023 and 2024 is gone. The stock is now a bet on execution against an increasingly complex competitive landscape, at a valuation that leaves no room for error. The next 6 months will be defined by three things: whether the Vera-Rubin transition goes smoothly, whether hyperscaler capex continues to grow at 70% plus or decelerates to something more normal, and whether custom silicon begins to show up in the revenue numbers of Nvidia's largest customers. If all three break positive, Nvidia is at $300. If two break negative, Nvidia is at $150. That range, a 2-to-1 asymmetric downside, is what a 41 times PE stock with a decelerating growth rate and rising competition looks like. The earnings were a blowout. The risk is blowing up the portfolio anyway. I'm Daniel Reed. This has been Market Lens. I will be back tomorrow with a full breakdown of the hyperscaler capex cycle and what the power infrastructure trade means for the second half of 2026.